Welcome to TalkTickers, your shortcut for getting up to speed on earnings calls.
We cut through the jargon and give you the need to know.
Exactly. Today, we're diving into the latest report from a major player. We'll pull out the key financials, management's take, and what they see coming down the pike.
Let's get right into it.
Okay, so top line numbers first.
Sure. First quarter revenue landed just under $1 billion. Pretty solid.
Okay, nearly $1 billion. And profitability.
EBITDA came in at $338 million. And remember, EBITDA is earnings before interest, taxes, depreciation, amortization, and those rent or restructuring costs. It's key in this industry.
Right, the standard metric. How are margins holding up?
Property level margins were strong, 40%, which is basically consistent with last year, so good stability there.
And shareholder returns. I heard something about buyback.
Oh yeah, big time. They bought back $328 million worth of shares. That's about 4.5 million shares taken off the market.
Significant. Any dividend news?
Yep, they bumped the quarterly dividend up to 218 cents per share. That's for the April payout coming up.
Okay. And debt levels. Leverage.
Total leverage is sitting around 2.8 times. If you look at lease adjusted, it's maybe closer to 3.2 times. So pretty healthy.
Good, good. One more highlight before we dive deeper.
The online segment really showed some strength. EBITDA was up nearly 14% year over year.
14%. Nice.
Yeah.
Okay, so a decent snapshot overall, but you mentioned some headwinds earlier.
Absolutely. It wasn't all smooth sailing. They faced challenges, particularly bad weather impacting their Midwest and South segment.
Right. Weather's always a factor there.
And then you had the leap year comparison, which always makes Q1 look a bit tougher, you know.
True, that extra day comparison.
Plus, last year's Q1 had the Super Bowl boost in Vegas, so a high bar to clear this time around.
Yeah, forgot about the Super Bowl effect. So despite all that,
overall performance was pretty consistent. And maybe more importantly, they kept seeing growth from their core customers across the board.
that core customer strength is key. Let's break down the regions then. How did Las Vegas look, specifically the locals market?
Vegas locals revenues were, well, nearly flat year over year. EBITDA dipped slightly, less than 4%.
Okay, so a small dip. Any specific reason?
It seems primarily driven by the Orleans property, although the good news is the decline at the Orleans actually narrowed compared to last year.
Interesting. What if you take the Orleans out of the picture?
That's where it gets interesting. If you exclude Orleans, the rest of their Vegas local spots actually showed modest revenue growth. EBITDA was flat, and they kept operating margins above 50%. Really strong.
50% margins, wow. So Orleans is the main drag there. What about downtown Vegas? More tourist focused, right?
Yeah, and downtown looked better. Growth in both revenue and EBITDA there.
What drove that?
A big piece was improved traffic from Hawaii compared to last year's Q1.
Back to the Super Bowl effect again.
Exactly. Airfares were sky high last year because of the game, kept some Hawaiian visitors away. This year was more normal.
Makes sense. But they don't expect that specific comparison boost to last, I assume.
No, management was clear on that. They cautioned that favorable comparison probably won't continue through the year. It was more of a Q1 normalization.
Got it. Okay, let's shift to the Midwest and South. You said weather was a big issue there.
It really was. They reported a 28% increase in days impacted by weather. That's pretty significant.
28%. So how did they manage growth?
Impressively, they still pulled off revenue and EBITDA growth in the segment.
Wow.
Management said once the bad weather cleared up in late March and into April, the business trends snapped right back to where they were in previous quarters. Resilience there.
Okay. Any specific property news from that region?
Yeah, a couple things. The new treasure chest facility hits its 1-year anniversary on June 6th. So we'll see how that annualizes.
Right, the land-based conversion.
And unfortunately, they did have some temporary closures at Belterra Park and Belterra Resort earlier in April because of flooding on the Ohio River.
Ooh, flooding too. Tough quarter for Mother Nature impacts there.
Definitely.
Okay, let's go back to the online segment. You said nearly 14% EBITDA growth. What's behind that?
It was driven by stable market access agreements, those deals letting them operate online where they don't own a casino, and just strong performance from their own Boyd Interactive platform.
So partnerships and their own tech working well together.
Exactly. And they also made a point to highlight their 5% equity stake in FanDuel. They see that as a, quote, significant and growing asset.
Interesting. So value beyond just their direct operations. What about the managed side of the business?
Managed and other also did well. The main engine there is the management fees from Sky River Casino, which keep growing.
And Sky River's expanding, right?
Yep. Big expansion underway. Hotel, more amenities, scheduled to finish mid-2027, so those fees should keep contributing nicely.
Sounds like they're definitely investing for the future. What else is happening on the property enhancement and growth front?
Quite a bit, actually. They're doing work at IP, Valley Forge, and the Orleans, plus a big renovation at the Suncoast Casino floor, public areas that should wrap up Q1 next year.
Okay, keeping existing properties fresh. Any new builds or major expansions?
Yes. The convention center expansion at Ameristar St. Charles is set to open this fall. And they said pre-bookings are strong, especially from new customers, which is a great sign.
That's promising. Anything else breaking ground?
They've started construction on Cadence Crossing Casino, that's in the southeast Vegas Valley. Should open mid-2026. It's replacing the older Joker's Wild property.
Good placement property. Got it.
And there's potential for future expansion there, too, down the line.
Any longer-term projects planned? Further out?
They're designing a replacement for the Paradise Riverboat in Illinois. The plan is to build a whole new land-based entertainment facility there.
Another riverboat conversion, then. Like Treasure Chest.
Seems like it. They expect regulatory approval and construction to start sometime in the next 12 months.
Okay, Illinois. Anywhere else?
The big one is Norfolk, Virginia. That $750 million resort project is underway.
Yeah.
Casino, hotel, dining, the works. Expected completion is late 2027.
Wow, $750 million. That's a major project.
It is. And interestingly, they're planning to open a smaller temporary casino in Norfolk this November, sort of a primer for the main event.
Get the market warmed up early. Smart.
Seems like the strategy. So yeah, lots of capital going into growth.
Which brings us back to capital allocation.
Yeah.
Lots of projects, but also those big buybacks. How are they balancing that, especially with economic uncertainty maybe lurking?
Good question. They confirmed they're sticking to the $100 million per quarter in share repurchases as a baseline.
Okay, that's committed.
But they also signaled they'll be more conservative with additional buybacks beyond that $100 million for now, given the economic outlook.
So prioritizing the balance sheet and the committed CapEx.
Exactly. Balancing shareholder returns with funding these projects and keeping the balance sheet strong seems prudent.
Makes sense. Did they give any color on current customer behavior? Like, are people pulling back?
They said through the first 3 weeks of April, they hadn't seen any significant shifts. Spending patterns, visit frequency, all looked pretty consistent with March.
So stable for now, at least through mid-April.
That was the message, yeah. Stability in the core customer base.
Okay, let's quantify the investment again. What's the total capital expenditure planned for the year?
They spent $127 million in Q1. The full year forecast is between $600 and $650 million.
And that covers?
It covers everything. Maintenance CapEx, the hotel projects we mentioned, the growth initiatives like St. Charles and Cadence Crossing, plus the casino development they have going on in Kenya.
Interesting. Are they worried about supply chain stuff, tariffs?
They mentioned they've taken steps to mitigate potential tariff impacts. And importantly, they have flexibility. Some projects can be deferred if the economic picture darkens significantly.
Good to have options. Now, there was a financial detail, the tax pass-through. Can you explain that?
Sure. In their own segment, the tax pass-through amount was $130 million this quarter. That's up from $116 million last year.
And the impact on margins?
It's significant. They said if you exclude that pass-through, company-wide margins would have been 5.2 percentage points higher, or 520 basis points.
Wow, okay. So important context for the reported margin number.
Definitely. But they also stressed, overall leverage is healthy, no near-term debt maturities, and they're generating strong free cash flow. So the underlying financial health looks solid.
Good. What about those riverboat conversions? You mentioned Paradise in Illinois is next. Are they planning more after that?
They confirmed they do have a prioritized list based on expected returns, using Treasure Chest as a kind of template. Paradise is next up.
But the returns might be different.
Yeah, they cautioned that the market dynamics in Illinois mean the return profile for Paradise might not perfectly mirror Treasure Chest's success. They're being realistic about it.
Makes sense. Each market is different. We talked about core customers holding steady. Did they give any more detail there, like frequency versus spend?
Yes. They noted growth in both frequency of visits and the average spend per visit among their core players, which is obviously a positive combination.
Definitely. Any changes in the promotional environment? Are competitors getting aggressive?
They said no. Haven't seen any significant shifts in promotional levels across their markets. Seems relatively stable on that front, too.
Okay. And back to Hawaii quickly. You said the comparison normalized after the Super Bowl airfare spike last year.
Correct. Last year's Q1 was artificially low for Hawaiian travel due to those high fares. This year is just back to normal patterns.
Got it. And did they quantify the weather impact this quarter?
They estimated about a $5 million hit to EBITDA from the weather disruptions.
$5 million. Okay. Let's swing back to Vegas locals again. You mentioned Orleans was a drag, but overall share loss was narrowing.
Yeah, that was the message. The rate of share loss in the locals market is slowing. And again, if you strip out Orleans, their other properties actually outperform the overall Vegas locals market.
So the competitive pressure is really localized at Orleans.
Seems that way. But management also sounded pretty bullish on the broader Vegas economy's resilience.
How so?
They pointed to how much more diversified the economy is now compared to past cycles. Less reliant purely on gaming, which they believe makes it less vulnerable to downturns.
Interesting point. A more stable Vegas overall. Did they comment on that proposed no tax on tips policy we've heard about?
They were asked about it. They said they haven't done a deep dive analysis on the impact, but acknowledged it would likely be a net positive for their customer base if it happened.
Makes sense. What about their own online brand, Stardust? What's the strategy there?
The Stardust iGaming platform is aimed at serving customers where online gaming is legal, both in their existing markets and nearby states.
Big expansion plans?
Not really. Their strategy sounds more focused on modest growth, maybe some smaller tuck-in acquisitions down the road, rather than huge, splashy market share grabs in iGaming.
Okay, a measured approach online. Finally, cost control. Always important. Any updates on managing expenses?
They just reiterated it's a continuous focus, especially on the land-based side. And they feel confident they can adjust variable costs quickly if revenue trends shift, using lessons learned back during the COVID period.
Good muscle memory there. Anything else minor?
Just a few quick things. Exposure to Canadian tourists in Vegas is tiny for them, less than 0.1%.
Okay, negligible.
They also mentioned their long relationship with Hawaii and expect to be involved if gaming ever gets approved there. Though they don't think online sports betting in Hawaii would hurt their Vegas business much.
Right, different experiences.
And confirmed again, the core customer is stable, resilient, even in downturns. No change on reopening Eastside Cannery Market doesn't support it now. And yes, the road construction near the Trop interchange is still impacting access, especially for the Orleans, but hoping it improves later this year.
Okay, comprehensive rundown. Thanks.
All right, let's shift gears. This is not financial advice. Time for our outrageous but plausible trade ideas, just for informational fun, remember.
Purely informational. Let's hear idea number one.
Okay, given that transitional casino opening in Norfolk, Virginia this November, way ahead of the main resort in 2027.
Right, the smaller temporary one?
Exactly. Consider this, and it's highly speculative. A short-term bet on regional suppliers or even construction-related companies with a big footprint right there in the Hampton Roads area of Virginia.
The logic being?
The early buzz, the immediate infrastructure needs for that temporary setup might give some of these very local businesses a temporary lift. It's super localized, very time-sensitive, before the main event years later.
Very niche. Okay, outrageous idea number two.
This one ties into the renovations at Suncoast in Vegas and the eventual rebuild of the Paradise Riverboat in Illinois.
Hey, those big projects.
Look into publicly traded regional contractors, the ones specializing in casino and hospitality construction, maybe with known operations in Nevada and Illinois, respectively.
So the builders themselves.
Or potentially even key suppliers to those builders. Think things like maybe specific types of fixtures, technology, that sort of thing used in casinos.
Okay, focusing on the supply chain for the build.
Right. Now, the impact on these, potentially larger companies might be small overall. But if one of them gets a nice contract win from these projects and it leads to an earnings surprise, could be a short-term gain, again, requires really close tracking of contract news and earnings reports. Very speculative.
Definitely requires homework. Okay, two outrageous ideas on the table. Let's wrap this up.
So, recapping today's deep dive on TalkTickers, we saw pretty consistent performance overall, despite some headwinds like weather and tough comps.
Yeah, and a clear focus on strategic investments for future growth. Lots of projects in the pipeline.
Alongside that commitment to returning capital via buybacks and dividends, but with, a layer of caution given the economy.
We hit the key financials, looked at how each segment performed, and got management's read on current trends and those future plans from Vegas to Virginia.
And remember that last segment, just ideas, food for thought, not financial advice. Always do your own thorough research before making any investment decisions.
It's absolutely critical. So what stood out most to you from this dive? What questions do you still have rolling around? Keep digging, keep analyzing.
Yeah, join the conversation. What are your takeaways? Thanks for tuning in.